So hopefully the clue is in the name as to what type of trading we're going to do today. Obviously, we will be looking at swing trading. Now, swing trading can mean different things to different people. We'll use sort of timeframes within a sort of group here to make sure that we're covering most of the timeframes that you guys would use. First things first, just to introduce myself, my name is Becky. My email address is there. If you turn your head on your side, you'll be able to read it. It's becky@tradictive.com. Let's just make sure we go through the disclaimers first. We obviously need to make sure that that's done. So obviously important for you guys to read these and understand them from a legal perspective, but also a good idea to understand that these kind of disclaimers are telling you that these videos are demonstrations, meaning I'm showing you what I would do. I'm showing you how we would use the technology. Ultimately, up to you to decide whether or not you want to ignore that, whether or not you want to take it on board, or something in between. So hopefully that makes sense. So I'm seeing people come into the room now. So hi guys, welcome. I know on FX Street, sometimes you guys aren't particularly chatty, but please be chatty. If you have any questions, if I say anything that makes sense or doesn't make sense, or you have any comments or any markets you want me to look at, just let me know in the chat. It means I can make it a better session for you guys to give you what you're really looking for. So don't be shy, say hello, chat with me on the chat box. I'm really happy to see that. Okay, just quickly, tradewithufos.com/Becky. This is a link that I would like you guys to go to. And the reason for that is because from here, you can set up a free Trade with UFOs membership. And then you can start asking questions in a public space. So if people have questions, of course, they can email me. I'm always happy to email back and help you guys. However, if a question is put in a public setting and therefore the answer is put in a public setting, then other people can learn from those answers and we help the entire community. So you see down here, there are answers to other questions that have been previously asked down here. So I just ask the same thing. If you guys are comfortable, if you have a question, put it here so that other people can see it. Okay, so let's crack on. Let's firstly look at the markets that we looked at last time. So I'm not sure which of you guys would have been with us last time, but let's just have a look at what happened last time to see what we might have done as we managed this trade. So just to be very clear, I know it might be obvious, but this black line here, that was our entry. That's the entry price that we had. This red line here was our stop loss. And then we had a safety target at this point and a final target at this point. Now, what we can see is that price came in, it triggered on the 21st of June. It was here. This is when price hit this this entry price. This is when we got in. And of course, it went off and it hit our safety target, which is great. Hasn't quite hit our final target yet, but we probably would have closed this trade already, depending on how strict we are. So around this point, if I just squidge this out here, so it's really, really easy to see. Around this point, 30th of June, we had a change in climate. Now, some people will say that they will stay in a trade only if the climate changes to a confirmed climate the other way. I would say if it changes to unconfirmed, I would cancel it too. Again, it depends on the person, how strict you are about that rules. If you are saying then if the climate changes at all to anything other than the reason I got into the trade in the first place, then I would get out. Then on the 30th of June, at some point in this day, depending on when you would have looked at the chart, you would have closed this trade out for a profit. So you'd have taken 1-to-1 here and then taken a little more than 1-to-1 here, or maybe 2-to-1 if you'd taken it out here, depending on which time of day you'd had a look. So overall, this would have worked out to a profit. If you're still in this trade, because maybe you set and forget and you don't check the climate and your rule is it's in until it's out, I'll get out at a target or I'll get out at a stop and that's my rules. Okay, no problem. Then you're obviously still in this trade because it hasn't yet hit our final target or hit our stop. In the way we would manage the trade, we would have already been out at a kind of trailing stop, call it that way, that we would have cancelled this trade for a profit some way into the trade. So hopefully that makes sense. So that was the dollar yen that we put on last time. I believe we put on a dollar Canadian. So let's see that. Yep, same situation here. It looks like we didn't get entered into this trade. No, we missed this trade. So this was the trade down here, entry price there, stop price there. For some reason the targets aren't there, but we probably had a target 1-to-1 away and probably up here as well. Now, with that in mind, we obviously missed the trade. It's gone way off, away from us. We never got in. So far on the trades that we put on last time, one of them would either be in profit currently or have closed for profit, and the other one we would have missed and not got in. So that's a summary of what we did last time. Now, what we're going to do today, same as we do always, we're going to bring up TradeStation and we're going to have a look for new opportunities. Again, if you guys, let's say you trade particular currency pairs on particular timeframes, let me know on the chat box. I'm very happy to go and have a look at them. Also, let me know. It's always helpful for me to know if you guys are new to trading, if you've been trading a long time, and then if you're new to this particular way of trading. So again, I can expand on it more if I need to, or be a little bit quicker about it if I need to as well, based on what you guys need. So you let me know there in the chat box. Okay, so whilst we are looking at this this chart or this sort of graph that we've got in front of us here, let's just understand what it is. And again, I know you guys that join me a lot, you'll know what this is. Just give me a couple of minutes to explain for those that may not know. So we have these yellow boxes. These yellow boxes are telling us where we have opportunities that are near. You'll see the word near in all of these yellow boxes. So this is scanning the markets for us. I'm using a TradeStation Forex scanner, scanning the markets for us and coming back and showing us in the form of these boxes, where do we have near opportunities? Now, we don't want to be looking at opportunities that are far away, because if they're far away, we're probably unlikely to be getting into those trades. Things change before we get entered. So we want to look at near opportunities. So again, it narrows it down for us. Then you might see that some of them are in bold and say near sensible, long or short, and some of them are sort of faded out and they say near hopeful, long or short. Of course, as traders, we want to be near sensible. So we're going to get rid of these and look only at the ones that say near sensible and that are yellow. So again, we would just remove a lot of these. So let's just do that. Be quicker here and then. Okay. So we filtered this down even further, and we're going to do one more thing to filter it down even more to again be much more specific on what we're looking at. So we also have this column here, and you'll see this column is either grey, blue, or red. We want to only look at the ones that are blue or red, because that tells us we have a confirmed climate on that market, meaning that we have probabilities on that market to the upside or the downside. So for this case, we would remove these first two. There you go. And we would remove this one. So we're left with just one to be looking at, which would be the New Zealand dollar on the 240-minute climate. We'd also get rid of this one here because it's grey. We would get rid of this one and this one. And we would get rid of this one. Also, you'll notice there's one here that's not yellow anymore. So we get rid of that one as well. So we're left with, if we're looking at daily climates first, which is what we will look at first, unless you guys want me to look at something else, we are left with three opportunities. We are left with Aussie yen, Canadian Swiss, and I believe that's pound Canadian. So that's what we'll be looking at first, and then we'll move on to the smaller timeframes if we can't find anything on those bigger timeframes. Okay, so let's start with the Australian yen. Again, if you have any questions on what I just went over, just let me know there in the chat box, guys, so I can expand on it if you need. So Aussie yen, let's take a look. Today, what we're going to do is we're going to have a look at MetaTrader instead of TradingView, although I'm not sure I have the symbol there for it. So in which case, what we'll do is we'll do TradingView for the cross pairs, and we'll do MetaTrader for the majors. So let's just delete this, and we're on the right time frames and stuff already here. So we had Aussie yen. So we'll do Aussie yen here, we'll do the cross pairs here, and then if we have time to look at some majors, then we'll go to MetaTrader. Okay, Aussie yen. Alrighty, so we have, when it comes to the Aussie yen, we have a thick red dot. That tells us on our AutoClimate app, which, by the way, guys, AutoClimate is a free app on most platforms that we have it on. You can download it for free. What it does is it tells us in the form of these dots where we have probability. Do we have probability up? Do we have probability down? Or do we have probability nowhere? Neither way. If it's a thick red dot, like we have now, that tells us we have probability to the downside. If it was a thick blue dot, like one of these, that would tell us we have probability to the upside. If it's a thin dot of either color, so one of these, slightly harder to see, but kind of the point, thinner dot tells us not enough probability either way, do nothing, change time frame, change market. For the time being right now, we have a confirmed downwards climate, thick red dot, so probability downwards. That means we have probability down, we should probably be looking to short. Now, that doesn't mean that we just go and sell at whatever the price is right now. That would be extremely subjective, getting into the market based on the time of day we happen to be looking at it. We want to be getting in and out of these markets at times where we have greater probability. And that's where these guys come in, which is our auto UFOs. So they look slightly different on the different platforms. So this is what they look like on TradingView. This is what they would look like on MetaTrader. Similar kind of thing. We've got these sort of boxes or lines, and then we have these little UFO looking dudes in the middle there. Now, the good thing about these UFOs is that they highlight to us exactly where, for example, in the case of green UFOs, it tells us on the right-hand side, between these two prices, this is where we have buy orders. If we're going to buy, we want to buy where there's lots of other buying. It's much more likely to push price upwards. In fact, in this one, you can see it already worked. So price went off from here. It came in, hit at this price, went up. It's come back, hit at this price again, and gone up a little bit. So it's already done its job to push price up a couple of times. Again, that's what we expect buyers to do. So we use this app to tell us where the buyers are. If it's sell orders, again, it will highlight to us, just pick this closest one here. It will highlight to us where we have the closest stack of sellers. If we want to sell where there's lots of other sellers. It's much more likely to push price down. So we use the auto UFOs to go and find where we're actually going to buy and sell. So auto climate is used to help us decide if we're going to buy or sell, and auto UFOs helps us decide where we're going to buy and sell. So we get more specific with it. Auto climate is a free app. Auto UFOs depends on the platform that you use. On TradingView, which is the one we're looking at right now, is $34 per month. Okay, so we have UFOs on the right, we have auto climate on the left. Now you might think, okay, great. We have thick red dot, probability down. We've got UFOs here. Brilliant. Let's put our trade in there. Now we add an extra element here, and you don't have to. I always say it will depend on how strict you want to be. The more rules you have, the less trade you place. The less rules you have, the more trade you place. In theory, the more rules you have, the more likely it is that the trades you place work for you. The less rules you have, the less likely it is that the trades you place work for you. So ultimately, it's up to you, depending on your patience, depending on how risk tolerant you are, how comfortable you are, maybe losing 5, 6, 7 times in a row before you're then right a few times in a row. Those things are subjective and should be up to you. The most important thing is that you are consistent with it. So if you only ever look at auto climate and then the auto UFOs, and you ignore this third piece that I'm about to explain, great, just make sure you do that all the time. If you sometimes add an extra variable and sometimes don't, you're being inconsistent. So you want to make sure that whatever your rules are, you are consistently applying. So for us, we've got our auto climate, we've got our auto UFOs. We now want to add an element here with our EMA on the bigger time frame. So you might notice as well, by the way, we have a daily chart here on the left-hand side and a 55-minute chart here on the right-hand side. If you can't get 55, so for example, with MetaTrader, you might have daily on the left and an hourly on the right. So it's only changed by 5 minutes. You know, the timeframes are pretty similar. If you can't get the more sort of weird timeframes, if you can get the more weird timeframes, 55 minutes tends to work a little bit better there than the hourly chart, just by a little bit there. Okay, so on the daily chart, we also have an EMA. The EMA is 83.326, which is obviously going to be around about here. That's where the EMA is. And why is that important? At the EMA is where buyers and sellers come in. It's a very commonly used indicator by many retail traders, as well as fund managers as well will use this. Sound has dropped out. Oh, so you can't hear me? I've just seen there on the chat, sound has dropped out. Can you guys hear me? Let me know on the chat there. I'm just seeing there from Bill that the sound has gone. So I just want to see if you guys can hear me. Sound is okay there? Okay. Alrighty, I'm not sure, Bill, obviously if you can't hear me, you can't hear this, but I'm not sure if that might have been your end. It seems like it's okay from the admin side. So I'm going to continue, but perhaps, Bill, if you can let me know if you do hear me again, that might be helpful to see if it's come back for you. And everybody else as well, if you can hear me, let me know. Obviously, if nobody can hear me, then we'll stop for a second, do whatever we need to do tech-wise. But if people can hear me, then that's great. Seems like it's good with admin. Okay, I'm going to continue for now. Hopefully, I'm hoping people will let me know if they can't hear me there on the chat box. So back to the EMA. Okay, all good there from Carlos as well. Okay, I think it might be Bill's end then. That might be the problem there for him. So I'll continue here and hopefully we'll be able to figure out the sound. Hopefully admin might be able to help if that's okay. If there's something they can do. Great. All right. So with the EMA, why is it important? It's important because this number will be where sellers come in for whatever random reason. So when the EMA hits price, if the EMA is above price, people will sell. Sellers will come in. It's a very, very common application using this indicator. So people will sell at that price. And if that EMA also happens, remember the EMA was around about this price. If the EMA also happens to coincide with sell orders, then we have sell orders from the UFOs plus sell orders from the EMA in the context of a downwards climate where we have more sellers. That gives us three separate, sort of almost unrelated things there, telling us where we have or that we have probability to the downside. So you might be somebody that just uses the EMA, just the climate in EMA, or just uses climate in Alta UFOs. That's fine. We use all three, which means we need that EMA number to coincide with sell orders. And in this particular case, it doesn't. So we would move on and not even place a trade. Because for us, there's no point placing a trade unless we have enough probabilities. And we define enough probabilities by having all three of these things line up. Again, you may just use two of them, and that's fine too. Just to say, if you did use two instead of three, that's not to say that you're going to lose more. It might be that you have a lower probability, but more trades, and overall that works out at the same kind of monetary value. So you can do two instead of three if you want. For us, we are using all three of these things lining up before we place a trade. So hopefully that makes sense. So we'll come back to TradeStation here and look at the next market that we're going to look at, which is going to be the Canadian Swiss. Things have moved about a little bit here. They've kind of been a little bit more efficient for us, giving us the three that we want at the top there. So Canadian Swiss will be the next one that we look at and see what we have there in terms of opportunity. So Canadian Swiss and Canadian Swiss. So we do have a trade here, so that's great. Let's put this trade on. So let's just quickly explain why. Thick red dot there, probability downwards. Now we've also got something even better with this climate, which relates to these numbers here. Essentially what these numbers tell us, the first number tells us how many candles that market usually goes up for. So if it says 4.69, let's round that up and say 5. So this market would usually go up for 5 days in a row before it changes direction. It would usually go down for 4.7 candles. Okay, let's round that up and say 5. So it usually go down for 5 candles, which is a daily chart here. So 5 days before it changes direction. And we are currently on the first candle to the downside. So that tells us, based on what usually happens, we've got room here for this trade to go with us, which is something obviously that we want to be in if we can. Again, this isn't essential. It's just an extra little thing there that gives us a little bit extra probability, which we like. So thick red dot, probability down. Great. We want to be selling. We have UFOs here. This closest UFO between these prices is where we're going to have stacks of sellers that we want to be getting in with. Probably because we have two UFOs very close to each other. By the time we do the maths, we'll probably have an entry here and a stop here. Sort of combine those two. Now, we're using those two because let's just put lines in. Let's say we're using these two. Our EMA, let's use pink for our EMA. Our EMA is 89.43, which is here. Nice and snugly between those two lines. So we have three things lining up. We have our climate, our UFOs, and our EMA all around the same place, all saying the same thing. So great, let's place that trade. Now, what I'm going to do, I use my Fibonacci retracement lines. For those of you that use this as a trading tool, you'll hate me for this. I use them as a drawing tool just to really highlight for me on the chart really easily to come back to what we were doing there. So I'll use this to highlight our entry and stop. So our entry is actually going to be this line here. So it's going to be 89 point. So you see here, this price here says 89.324. So we're just going to round that down to 89.32. That's going to be where our entry is. Our stop loss, you see this price here, this top number is 89.789. Let's first round that up to 89.79, and then we're going to add 7 pips there as a bit of wiggle room plus the spread. So if it was 89.789, rounded up to 79 plus 7 gives us 86. Okay, there we go. So that's our entry and our stop. Pretty easy so far. Now, where are we going to put our targets? First target is really, really easy. It's 1 to 1 away. And I'm going to use the control panel here to help me work out the maths on that so that I don't have to do it myself. We'll use technology to help us here. So I'm just going to put in, it's a sell limit. I'm going to put in what the entry price would be, which is 89.32. I'm going to put in what the stop loss will be, which is 89.86. That's now figured out for me. That's 54 pips between entry and stop. If I'm doing a 1 to 1 target, then I want my target to be 54 pips away. So all I need to do is type in 54, and there you go. It's told me what the price would be, 88.78. So again, I'm just going to use a drawing tool here just to put this on the chart, make it easy for you guys to see where it is. It's 88.78. That's going to be our first target. Really, really easy. Now, what I'm going to do is I'm going to put $50 of risk on this target and $50 of risk on the second target. So overall, the trade would be $100 worth of risk. Of course, you guys are going to have different rules, different amounts of money, different percentages of your account that you use. I'm using $100 just because it's a nice round number. So we'll do $50 on one, $50 on the other. So we're just going to check that everything's right there. So we've got 89.32. That's our entry. Great. We've got our stop loss, 89.86. Great. And we have our profit target at 88.78, and it's 1 to 1 away. $50 risk, we'll click sell. Great. So that's now gone in as that trade. Now you might be thinking, okay, great. 1 to 1. Brilliant. That's not going to make me too much money. And you're right. That's why we will use a second target in order to capitalize more on this trade if it does go in our favor. So see this UFO here on the bigger time frame. This number here is 86.726. We're going to use that number to be our final target. We'll add a couple of pips to give it a little bit of wiggle room there for the spread, but that's the target we're going to use. Why are we using that? Because if on a daily chart we have confirmed probability downwards and we're getting into sell orders that are going in that direction with our EMA, then probably price is going to continue to go down. What stops price going down? Buyers, lots of them. That's what's going to stop price going down on this time frame. So we're going to get out at that point, because at this point is where we're probably going to see a change of direction, because price is going to hit buy orders. Now it may be that in the meantime, while price is on its way down, we get a new climate, it pushes price upwards, or we get new orders come in that pushes price upwards. And that would be okay. We would perhaps get out at a trailing stop at that point, or get out if the climate changes. So we're going to aim for this place, but we'll manage our trade in between to capitalize on the profit if we need to in the meantime. Just seen a question come in. Do you believe that a correlation of higher confidence on filters could offer better trade results over time? Does the data point to that? Okay, so correlation of higher confidence on filters. Do you mean a correlation of having more things going in your way for the variables? Is that what you mean there? Higher confidence, are again assuming higher things sort of lining up on the filters. Again, I'm thinking that might be on different variables, so more things lining up at a greater percentage. If that's what you mean, then yes, that is true. In theory, let's just make a little bit of white space here so I can draw this out a little bit easier. So in theory, let's say you have 10 trades. And the way you've done it is you have loads of things lining up on your favor. Yes, okay, brilliant. So the variables you were using, like the EMA, the zones, yes, exactly. So if you are lining those things up and you have greater confluence there, so you have more things sort of ticking the boxes, then let's say out of 10 trades, you might have 6 that win, and let's change the color, 4 that lose. For example, this is just an example numbers, okay? It's not exactly these numbers. It depends on loads of other things. Remember that each currency pair is a variable, each time frame is a variable, each time of day that you trade is a variable, your risk tolerance is a variable. All these things are different variables. But if we're talking about methodologically, then let's say, for example, this might happen. Now, that might be opposed to having less confluence, so less things lining up, where out of 10 trades, you might have 5, say, that win and 5 that lose, for example. Now, you might say overall, brilliant, well, I'd rather do this one because I'm right more often. I make profitable trades more often. So great. But let's say, for example, because you're being stricter, in the course of a month, perhaps you have 10 trades that fit all of those things. Maybe down here, you have 20 trades that fit all of those things. So if you have 10 trades, 6 are right and 4 are wrong, let's say, for example, what I might do here is actually just, I might delete that and just give myself a little bit more space. So let's say up here, you do 10 trades in the month. 6 are right, and each time you're right, you make 10 bucks. 4 are wrong. Let's change the color again there. 4 are wrong. And each time you're wrong, you lose 10 bucks. Okay, let's be really average with that. In fact, let's say you risk 5 to make 10. Let's say you've got a decent reward to risk. So over here, you've made 60. And over here, again, let's change the color. Over here, you've lost 20. So overall, you're up 40. Okay. Overall, you're up 40 from being stricter on your variables and having 10 trades a month. So I'm just going to put that up here and put 10, 40. So we know what that was. 10 equals 40. Now, let's say for the one that had less probability, but you had more trades because you had more, you were less strict on what you needed to get into a trade, then instead of having 10 trades in a month, you have 20 trades, which means we had a 50-50 right or wrong. Let's say you are right 10 times and you are wrong 10 times. So your probability rate has gone down. The other one, you were right 6 out of 10. Here, you're only right 5 out of 10 or 10 out of 20. But that means, let's say we have the same reward to risk. So when we're right, we make 10. And when we're wrong, we lose 5. So overall, over here, we've got 10 times 10, which is 100. And over here, we have 10 times minus 5, which is minus 50. So overall, the profitability is actually 50. So because you had more trades, or you allowed yourself to make more trades, you perhaps made more money, but more of your trades lost. Hopefully that makes sense in terms of the different sort of pros and cons there. That again, if we just delete most of this and go 10 equals 40, and on this one, so I have to do that again. So if you did 10 trades with higher probabilities, you might make 40. If you did 20 trades with lower probabilities, you might make 50. So this one's definitely more efficient. Definitely more efficient. You make more per trade. You make more per the amount of time that you're spending. But you place less trades and therefore overall make less than if you might have placed more trades. If you're placing more trades, say this one, let's use a different color rather than red because it's still profitable here. On this one, you've made more money overall, but you had to place more trades to do it and you had to go through more losers to do it. Pros and cons, it really depends how that individual feels. So to answer your question there, Carlos, yes, a correlation of higher confluence, so having more variables line up does increase your profit, your probability rate. Doesn't necessarily increase your trade results because it will lead to you placing less trades. But if you're a person like I would be, if you're a person that doesn't like being wrong very much and prefers efficiency, then of course you would choose to be stricter and have that higher confluence. If you're somebody that's a bit less patient, you like trading regularly, you like being in lots of trades, and you're okay to go through 4, 5, 6, 7 losers in a row in order to get the 2, 3, 4, 5 winners in a row, then great, you might go for this one, and overall you might make a little bit more money. But you're going to have to trade more and go through more losers to get it. So neither one's right or wrong. It depends on how you feel as a trader and how you interpret that. So that was a long way to answer your question, Carlos, but hopefully that does answer it and gives you an idea as to what would be the pros and cons then. Short answer to your question is yes. Okay, so I'll come back to that question in a second here, just as we place this trade that we have here, and then I will come back to that question that I see then. So we have this line here. This is the one that we're going to use for our final target. It's 86.726. We're going to round it up to 7.3 and then add a couple of pips. So 86.75. So all we're going to do is come here, type in our entry price again, which was 89.32. Our stop loss, it should have remembered, 89.86. And then we're going to click take profit. And in this case, we're just going to type over what the price will be, which is 86.75. Now, as you can see here, I'm just going to put in $50 again. This would be a 4.76 to 1 if price got all the way down there, 4.76 to 1. But bear in mind, we have half our trade at a 1 to 1 and the other half at a 4.76 to 1. So overall, it's going to be 2 point something, 3-ish to 1 if both of those trades hit our targets. And then we'll press sell. So there we go. So now we have our trade in here. If I just squidge this, you'll see the other target there. And what we're doing is we are selling at this point with the view that price is likely to move down from there because it's going to hit the EMA and it's going to hit sell orders. So it will come down in the context of a downwards climate. So price will come down. If it hits this first target and then goes against us, then we'll break even because we'll make 1 to 1 and then we'll lose 1. So we'll break even. If it continues down nice and smooth, then we'll probably make overall 2.8 to 1-ish, I think, because it will hit our first target and then it will hit our second target. What's more likely to happen is price might move down on its way and then new buy orders might come in. And then it might stall for a little bit, and then it might come up a little bit, and then it might go down a little bit, then it might go up a little bit. If in that our climate changes to anything other than a confirmed downwards climate, then we would cancel the trade out at a profit. Kind of like the one that I was explaining right at the start with the dollar yen that we would have done for last week's trade or last session's trade. So it would be the same thing here. If the climate doesn't change, and it might just slowly make its way down, but the climate is still continuing to be, actually it would be red, wouldn't it? Continuing to be a thick red dot here, then great, we'll stay in this trade until it gets us out at profit. More than likely, we will get out somewhere in between with our climate changing, just because it's a reasonable distance away, but we will see. Overall, we're hoping that it doesn't go straight through and stop us out. But if it does, we would lose, in this case, $100 for this trade, which is what we decided we were going to risk. Okay, so I have a question there from Carlos. So as long as the system could be profitable with a long-term sustainable winning percentage, such as 33%, for that we need certain parameters of ROI and so on. Exactly. So again, I'm just going to move this up here, do some maths. So again, let's just, I do 10 just because it's easy, right? Let's say out of 10, in fact, we'll do 100 because you said 33%. Out of 100, if 33 of them are right, meaning 67 are wrong, that can still be profitable, providing, let's say when you're right, you make, I don't know, let's say when you're right, you make $20, and when you're wrong, you make, or you lose $5. Then you would do the maths on that. I can't do that in my head, so I'm going to get a calculator out and do this. So if you did 33 times 20, so that's 660, but then you had 67 times minus 5, which is, 67 times 5, let's do that. So 335 minus 660. So you would be up 325 in that case, even though you were wrong more than you're right. Yes, exactly. Times 3. So you want a 3 to 1 there. Okay, so if you want to do a 3 to 1, then you could do 33 times 3, assuming that it could be $3, it could be 30, it could be 300, whatever you want to do. So you'd make 99 there, minus 67 if you lost one each time. So you'd be up 32. So you'd still be profitable. Now, what I think is important to note, because sometimes people will go, brilliant, well, in which case I only need to be right 28% of the time or 29% of the time if I put targets at 3 to 1 away or something like that. And that's for sure true. The issue with that is if you are right 30 times and wrong 70 times, you'd still be profitable. Just if you did 3 to 1, still be profitable. But it's not that it would go win, 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 loss, 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 win, win, win. That's not how it goes. That's not how the statistics work out. It might be that you have win and then loss, 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 and then win, 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 win. Which means you have to be okay to go through these. The statistics overall out of 100 trades might tell you that you were wrong 70 times out of those 100 trades and right 30 times. And overall, that would be profitable. But if you're going through 10, 12, 15 losses maybe in a row as part of those 100 trades of data, are you going to be psychologically comfortable with that? That's the thing that I think we really need to ask ourselves. If you are psychologically comfortable with that and you're fine to take as many losses as it needs because you know you've done your back testing, you've got the data, you know that sometimes that happens, and overall you're going to make profit out of 100 trades and you'll go through as many losses as you need to, you don't care, you're still going to get up at the same time, still going to place the trade in the same way, great, do that. If that would affect you, and for a lot of us that would affect us, then you might want to play about with being stricter on these numbers, what your profitability rate is, therefore being stricter on your variables, stricter on those confluences, so that it's maybe 40-60 or 50-50. It might be easier to, instead of having 3 to 1s, do 2 to 1s that are easier to hit and be right 50% of the time, than it is to do 3 to 1s that are harder to hit and be right lesser percentage of the time, from a psychological perspective. Maybe not the way the numbers work out, but from a psychological perspective. So we need to bear that in mind as well, not just what the data says, but in reality, when I do that, how am I going to be able to do that? Am I going to be okay with it? Is it going to be psychologically manageable for me so that I keep doing my methodology in the way that I need to? So hopefully that makes sense there, Carlos. Thank you for those questions. They're really good questions. And I think it should help people to think about, again, how strict they are with variables and where they sit on whether or not they would go for higher probability, but perhaps less money, or less probability, perhaps higher money. And again, how they feel about going through those losers to get there. So thank you for those questions, Carlos. It brought us onto some really good topics. Okay, so we have this trade in here. I'm just going to make a little note for myself here. So placed 7th July short. I'm just going to put that in there so it's easier to see next time when we place this trade. Okay, so let's go back to TradeStation and look really quickly. I know we've only got a few minutes left. Let's just see if we have something really quick we can look at. We've got pound Canadian there on our daily climate, so let's take a quick look there and just see if we have anything, and if we do, we'll put it in real quick. If not, then we won't. Okay, okay, so in this case, just to explain why we wouldn't place this trade, in this case, we would be looking to go long, perhaps, because we'd have a thick blue dot there that tells us probability upwards that we should be looking to buy. We have buy orders down here, but our EMA, I'll just move this out of the way for a second, our EMA is 1.7132, which is here. Now that's not lining up with our UFOs. Now what you can do in cases like this, because obviously the EMA, the MA stands for moving average, right? The M is moving, it moves. As price moves, so too does the moving average. So if price were to move down towards our UFO, then it's likely that the EMA would also be moving down, and perhaps at the time when it would actually hit and collide, might even be within this UFO. We don't know that, that's kind of speculation for now. So what we would do in this case is perhaps set an alert. So the entry for this trade would be 1.7134. So you round it up, 1.7114 plus 2, 1.7116. That would be the entry for this this trade. So in fact, let's just draw it. We probably would just do it the other way around. So the red line is the stop. So it'd be 1.7116, and the stop would be 1.7092, and we just minus 5 from that, so 87. There we go. And before we included 2 UFOs, the reason for that was because the numbers would have overlapped once we added wiggle room for the stop. Hasn't happened here, so we would just take this first one. So if price were to move down towards this, the EMA is likely to move too. So we could set an alert at, let's say, 1.71125 or 1.71140 or something like that, round about here, so that when price does move down, if price does move down, we've got an alert at that point. We can then see, where's the EMA? Is it lining up, yes or no? If yes, then we'd place that trade. If no, then great, we didn't place the trade anyway. We just continue to ignore it or move on. Hopefully that makes sense. So let's just go back to this thing really quickly here on TradeStation, just so I can point you guys to what might be good things for you guys to go and look at after the session. We've already done the daily climates on our cross pairs. We've placed one trade and we have looked at a couple of others. On daily climates on our majors, we have nothing actually that would work for us right now based on what we see on the scanner. What we do have on slightly smaller time frames, if you were to use the 240-minute climate, you've got the New Zealand dollar that you can look at. If you've got 240-minute for the higher time frame, by the way, you want to use a 21-minute for the smaller time frame, or 15, 20 minutes if you can't get the sort of slightly odd time frames. So you've got the New Zealand dollar there that you can look at, and you also will have quite a few over here: Swiss yen, Euro Aussie, Pound New Zealand. You'd also have Pound Canadian, Pound Swiss, and New Zealand yen. So these would be the different markets that you can go and look at that we know, at least from the scanner, are close, that have confirmed climates, and that are sensible, meaning that they make more sense to do. But go and check them. Of course, there might be other variables that you want to line up. There might be, when you look at it, it might be that the EMA doesn't quite line up with the UFOs. So go and check them. But these are the markets you can be looking at for the time being if you follow this strategy and you want to go and take this further now and go and have a look at that. So hopefully you found this helpful, guys. Thank you, Carlos, for your questions. It was really nice to be able to explain that concept. I think it's a really key one and something that a lot of people struggle with. So it's really good questions. Thank you for that. If you have any questions after this point, you can email me, no problem, at becky@tradective.com. There's also tradewithufos.com/Becky. Get yourself a free Trade with UFOs membership, and then you can ask a question here. That way I can answer the question there and everybody else learns from the answer as well. Again, hopefully you found this helpful. Let me know if there's any questions. I will see you guys next time. I believe I'm here next week, I think. So I'll see you guys next week if that is. But otherwise, let me know in the meantime if you do anything or if you have any questions. Hope you guys have a great rest of your week, and I'll see you soon. Take care.